trade certainly is not helping, and I am not under the assumption this is going to get settled in a matter of days. I think this is going to be a prolonged issue. But when you take a step back, it's worth reminding ourselves this is not just about trade. There's been a broader economic narrative. You know, we came into the year, Sarah, with everyone talking about a synchronized global recovery. And instead, what we've had is a slowing economy, an economy where once again it's been the U.S. in the lead with Europe and China slowing. And that's been a change for investors. And when you layer on tighter financial conditions, it really isn't a big mystery why volatility has picked up in the back half of the year.
And so what do you expect, Russ? Do you expect more of the same then? Is it going to be a volatile next couple of months? Or will the midterms, will maybe some kind of resolution to trade take that volatility back off the table?
Well, in the short term, I think it's very likely, it's very possible you might see some strength in markets. We're going into a seasonally strong time of the year. Historically, the period after midterms has been strong, but I do think that's going to be temporary. And again, as we get into 2019, I don't think the trade issues remarkably disappear. There's a good argument that we saw peak growth in the global economy in late 17, so I expect a little more deceleration. And again, I go back to this issue that has nothing to do with trade. The Fed is tightening financial conditions. The dollar's generally been stronger. Credit markets are wobbling a little bit. All of that creates a headwind for equities, and it creates more volatility.
So what do you do in that kind of environment?
I think you do a couple things. The most important, think about what are the hedges in the portfolio, what's going to be negatively correlated with stocks. And within the equity portfolio, I think there are a couple of themes. What are the parts of the market that are going to be more resilient? You know, a lot of 2017, early 2018 is about the momentum trade. I think we've entered a period where you want a different characteristic in the portfolio. You want quality. What does that mean? Companies with lower leverage, earnings consistency, and high profitability.
You know, hey, Russ, the U.S. markets, okay, at 16 times earnings, or 22 times forward earnings in the S&P 500 1 year ago. Now we're at 16. Yep. Some people still call that expensive. The Japanese stock market trades in single-digit PEs. It's on every metric. It is the cheapest developed market in the world by far, and nobody seems to care.
We care. Global Allocation Fund, we're overweight Japan. This has been in position for some time. It's been a tough position this year, but Brian, as you said, you know, one of the advantages of Japan, if you look at the world right now, I don't think the U.S. is particularly expensive, but it's not cheap. Europe's cheap, but you have problems in the banking sector. The economy is slowing even more. Japan, not only is it cheap, you're seeing rising profitability, you're seeing buybacks, and you're actually seeing, compared to the rest of the world, a fair amount of political stability. So right now, Japan is our favorite place within developed markets.